there is a thing called a liquidity trap. This is actually the actual definition. A liquidity trap is the situation described in Keynesian economics in which injections of cash into the private banking system, so listen to these words, injections of cash into the private banking system, a la QE, by a central bank, the Federal Reserve, fail to lower interest rates and hence fail to stimulate economic growth. A liquidity trap is caused when people hoard cash because they expect an adverse event such as deflation, insufficient aggregate demand, or war. Signature characteristics of a liquidity trap are short-term interest rates that are near zero. Federal Reserve is now at 1.5. And fluctuations in the monetary base fail to translate into general price levels. In other words, you can't create inflation. So I'm going to give you the reason why billionaires should exist. You know, you think about a company like Microsoft as an example. Microsoft has made thousands of people, potentially millions of people, depending on how you calculate it, much wealthier, right? Whether you own the company stock or whether you work for the company, directly the impact of Microsoft has made a lot of people wealthy. But see, what people forget is Microsoft has also generated an entire ecosystem of other businesses that have made people wealthy. There's an interesting thing about corporate profits and what makes up actual corporate profits. And there was an interesting company that jumped out. And this company made $55 billion in profits last quarter. Apple, as an example, $13.6 billion last quarter. Microsoft made about $9 billion last quarter. Apple, Microsoft, Google, Facebook, Amazon, JP Morgan, all combined made less in profit than this one company. You want to guess who the company was?
I'm racking my brain. I don't know.
It's a huge company. We talk about it every day, but we don't think about it as a company.
Don't think about it as the company.
Brent, you want to throw out a guess there? What company? It's something that we talk about we pretty much talk about this company every day on the show in one shape, form, or fashion. No, Facebook's in the list of the other companies, right? We talk about it almost every day in some shape, form, or fashion. And they reported they make more profit than Facebook, Amazon, Google, Microsoft, JP Morgan, all combined.
The Federal Reserve Bank?
The Federal Reserve Bank of the United States.
Wow. Good job, Brent. Wow. Well, I don't think of them as a company. I was thinking about that earlier, but I was like, all right, it's not a company, right? And they don't technically make profit per
Yes,
se.
they do.
Yes,
they do make profit. So people get this idea as well, capitalism is only for the rich. No, it's not. Capitalism is what makes people rich. If you take a look at the wealth in the country, it started at some point with somebody starting a business. All wealth in this country is created by people running their own business. Ray Dalio, largest hedge fund manager in the world. He managed $160 billion. He's a billionaire himself. Tons of money, right? Made it by running his business. Warren Buffett, $86 billion. One of the third richest men in the country. How did he do it? He built a business. Back in the 1960s, launched Berkshire Hathaway, grew a business. He makes his money by investing other people's money. It's a business. He makes money from that. All the wealth in this country, no matter where you trace it back to. Jeff Bezos started out with a $250,000 loan from his dad, started a book reseller online, now the richest man in the world. Took risk, had capital that he borrowed from his dad, had to wind up paying that back ultimately. I'm sure his dad's not too upset. Did that, right? Bill Gates dropped out of college to start Microsoft. I mean, the list goes on and on and on and on and on, right? But wealth is always created by running a business. Nobody got wealthy, really wealthy, working for somebody else. One of the things that happens to investors is they tend to start extrapolating out that the current trend is going to continue to exist indefinitely, that what happens this year will happen again next year. And this has been a very, very big performance year for the markets. Markets are up over 25% for the year, and at the current pace, we may be close to a 30% return in 1 year.
Here's the way I think about it. The market's up 30%, earnings, the economy, all of the stuff that drives corporate stock prices are up low single digits. So what you've done is pulled forward a huge amount of stock price returns. So yes, you may have gotten 30% this year, but you're only guaranteeing in the future that you're going to get less than average in the future.
Like in our own portfolio management practice, people always kind of question like, well, why did you sell part of that stock? It was doing so well. Well, that's why we sold some of it, because it was doing very well. We kind of look at our portfolio like a garden, and we plant the plants, and when they grow up and they, produce tomatoes, we have to harvest the tomatoes. If we don't take the tomatoes off, they just rot on the vine and eventually go away.
You have to take profits. We fully recognize this market is going up and may go up further, so we're not getting out, but we have a couple fingers on the trigger. We're taking profits when necessary and rotating the portfolio and doing what every good gardener does, and picking the ripe tomatoes and planting what's necessary, but understanding that eventually winter does come.